Michael, since Obama was reelected, stocks took a sharp decline. Now, a lot of people are blaming it on the reelection, but you don't think that's the case. What are you seeing out there that differs?
Well, as you'll recall from the prior times I've been on, I've been arguing that we were in a period of a correction, really after QE3 was initiated by the Federal Reserve, when the deflation pulse began beating within the markets. October, before the elections, was the worst October in 4 years. The weakness was already coming in. Now, what was interesting, I think, about the elections was that as much as everyone was focused on Obama, the week prior, Greek stocks had their worst week since May of 2010, which is when the flash crash happened. And what really sent stocks tumbling was when Mario Draghi started warning that the Eurozone crisis was finally having an impact on Germany. Now, as Greece is coming back into the headlines, I think the market is starting to get very nervous once again, making this almost a classic European-driven risk-off period. That's why you're seeing Treasury yields in the United States collapse in the absence of a Lehman-like event.
Okay, now, but with the QE3 on the table here now, with the Fed easy monetary policy, shouldn't that be helping the stocks?
And that's, one would think so. And the initial reaction was that it was going to be very bullish for risk assets. But sometimes the market behaves in a corrective way without actually going through a big decline first. It may very well be that the market thinks 40 billion a month, which is what QE3 is not enough. It's not enough in the context of Apple, which from peak to where it is now has lost about $100 billion in market cap. Yeah. That's 2.5 months worth of QE3 when the multiplier, the ability of that 40 billion a month to go through the economy isn't really working properly. I think that's one element of it. I think the other element of it is, in a way, by saying that you're going to keep it open-ended, what's the incentive for money to start moving now? Why would you go out now and buy a house if you know that the central bank is essentially saying, we'll keep rates low for the next 2, 3, 4 years until we get what we need to get? Mm-hmm. Psychologically, there's no urgency. And that may be actually one reason the Fed, the expression, never fight the Fed may be fighting itself, not knowingly, through this idea that they are affecting psychology negatively.
Mm-hmm. Okay. Well, now, so we are in this corrective mode, and I spoke with you earlier this year in September. You had said we're going to see a correction in the fall before we could see higher prices. Right. But are you surprised that we've been in this correction for so long, and how much longer are we going to be in this mode?
It's lasted for longer than I thought it would, and the deterioration has gotten much more severe than I thought it would. But there's two sides to this. One is, do we go much deeper down in stocks? I'm not convinced, and that's because of this idea I've been saying is the bear paradox, which is to say that with the 10-year Treasury yield at around 1.6-ish, any kind of a real deep decline in stocks makes stock dividend yields obviously rise relative to bond yields, which are already at panic low levels. So you have this yield spread happening.
Yep.
At a certain point, then, stocks become almost like a bond alternative from an income perspective, because a big, deep correction makes bond yields go lower, risk off, while stock yields go higher, right? So there's a little bit of a floor. The other aspect to this is, can you get new all-time highs? I still think it's possible if you get a resolution to the fiscal cliff. Yep. I think that could cause a surge of positive sentiment. And if you get past some of this public dispute now over what happens with Greece.
Okay, so what is your fund in right now? What percent is in equities versus bonds?
So we've been basically all in bonds for this entire juncture. So across our ATAC strategies used for our mutual fund and separate accounts, we are potentially close to a trigger move back into equities, but there has to be enough improvement within the market, and there has to be this belief that reflation is going to come back in for us to be comfortable with that kind of a trade.
Okay, any specifics on the type of movement that you would?
If you look, the emerging markets have been the interesting play during this corrective period. If you were to take a look at EEM, VWO, the big emerging markets ETFs, those have actually outperformed the S&P as we've been going through this corrective period. That trade is bullish. I think if you're going to get past this period, the emerging markets, which very badly underperformed for the last 2.5 years, probably are the place to allocate to.